Hello, everyone. This is Noah and John. It is Friday, so you're going to get your weekly Manhattan market update. Johnny, let's get right to it. I'm looking at supply, came in at 7,041 on its way down. Johnny, show me the chart.
It's down 1%. I mean, the number of units on the market for sale is just slowly dwindling before our eyes. And I'm surprised to be saying this in early March.
Yeah, I think it's because at this time of the year, we're just used to supply going up. So, like, we're a little confused. Everyone's wondering what's going on. Is it a fact of not a lot of stuff coming on, or is it something else? We will come to it at the bottom of this show. John, let's move to pending sales. The measure of demand came in at 3786. That looks like it's going up. Show me the chart.
Yeah, that's the real story. No, I mean, this is up nearly 4% from last week. And we only have a couple of weeks of year over year comparisons left before the COVID throws everything out the window. But
Right.
this is 46% higher than we were last week. So, supply, yeah, it's up over year. But I mean, come on, pending sales is just dwarfing it with 46% gains on a year over year basis.
Yeah, it really is a one-sided story. And let's go to the weeklies. Maybe we could see what's happening in the weeklies. John, I'm looking at supply. 397 things came on the market last week. That is up. Show me the chart.
It is up. That's like a 25% increase from last week. And it's honestly, that's the most we've had come on the market since October. So we're really getting into the swing of a lot of stuff coming on the market, which is what we would expect at this time of year. But it's just getting overshadowed, as we're going to see, by the number of units going into contract, as well as the ones being taken off market.
That's right. And that's where we're getting to the point right here. Everything is starting to become clear. Let's look at contract signed 322. I often say anything over 300 is just a market on fire. We usually don't see those types of prints. I don't know how long we could sustain it, but John, show me that chart.
What do you mean to say? It's up on the weekly level by 18%. It's up on a yearly level by nearly 46%. And if you want to find a week with more contracts signed than 322, you're going to have to go back to like May of 2016. That's a long time ago.
Yeah, unbelievable what this market is doing. And I want to point out on this market ticker right over here, 322 things went to contract in the last week. 252 things went off the market. You add those two together, it is a lot more than the 397 things that came on. All of a sudden, you're starting to realize why we are seeing a net reduction in inventory. That is why. John, let's move on to the charts outside of UrbanDigs. You did a lot of digging. Please tell our viewers what you did.
Well, we've been asked a lot about how the luxury market is doing. And, the luxury market's a really tricky one because, as we always say, each building and each unit's really its own market. And that's especially more so in the luxury market when you start getting a smaller buyer pool and very unique properties. But what we did is we basically looked at contract signs by property type in the luxury market. And you can see the pandemic hit, which is April 2020, when 0 co-ops in the luxury market were signed. And you can see that recovery. And look at just the number of condos just increasing. And really, this is a testament to the recovering strength that we've seen in the market.
Yeah, and again, we're looking at deal volume here. So I like to call this the liquidity chart. And you can really see the illiquidity in this sector. It really was for a few months over here. The recovery in condos is great. Is really quite amazing. Now, the only thing I guess I'm questioning right now is we're only going back to 2018. And when I go back over here and I draw my line, it looks like we're back to like mid 2019 levels, something along that nature. It does make me wonder. We're probably still down a lot from the 2014. I think luxury peaked out in 2014 before the 2015 broader market. So I'm going to move on, John, to our next chart, okay, which is the luxury market pulse that we have. And this is now going back to 2010. So we have a nice long picture here. And this is kind of what I was talking about here. If I look at where we are, right, let's just put aside the recovery for a moment. You can see that we are down still substantially from that 2014 level.
Yeah, you're absolutely right. We're well off the highs, but honestly, the recovery from the bottom has been significant. I mean, we were basically, we have these two lines. The bottom red line is sort of below that. It's kind of a buyer's market. In between the two lines is sort of a neutral stance, and above that's a seller's market. But we were sort of below that red line really since the later half of 2019 after the mansion tax increase. We had that huge pump of sales in the luxury sector. Everything sort of fell away. But, post-COVID, we've just slowly been recovering, and now we're solidly in neutral stance. So if you're a buyer out there in the luxury market, you may be seeing fewer choices, fewer deals, and the sellers being a little bit more recalcitrant to wanting to hit your low bid. At the same time, if you're a seller, you might be seeing more people at your open house, you might be seeing more appointments, and you might get a sense that the market, the luxury market it's moving.
Yeah, it's moving, but John, let's just take a look at how the 2 million and under sector is doing, right? Let's just be fair here for a second. And I don't want to downplay the recovery in the luxury sector. It is recovering. But now let's go out of the luxury sector and look at the 2 million and under market pulse. Look at what that market pulse did, right? In relation to what the luxury sector. And I cannot believe I am saying this, but for the 2 million and under sector, it looks like the real time market forces in the streets today are for the first time in 3 years, it looks like, in sellers territory.
Yeah, that's exactly right. Now, I don't know how this is going to go forward since we're sort of entering the active season. We're starting to get those
Right.
listings coming on the market, and I don't know how many more weeks we can have of over 300 contract signs to kind of shape this ratio. But you're right, Noah.
Right.
I mean, look at this. Look at the recovery from the low to the high there. It's almost reminiscent of the 2012, 2013 market, which is right when we started seeing the recovery after the great financial crisis. And this was really marked by sort of an inventory starved market where it just activity kept creeping up and less units were on the market. And we, got to a point where we reached a peak in 2015, 2016. I think there are some notable differences. The risks today are clearly a little bit more evident than they were back then, like COVID, a new presidential term, new mayoral election this year. We have some financial markets that are sort of at all-time highs. People are getting a little jittery about that. But, when you just look at this chart, wow, it looks like the market's fantastic. But I think if you look behind the scenes, you'll notice that, and this is also in the luxury market, and especially more so, which is that if you have an unrenovated unit you're trying to sell, you're not getting the traction you desired, simply because there's a lot more risk out there for those. If you've got a unit that's priced over the market, no one's really paying you much attention, and you're going to be taking a significant hit to sell it at the market. And this was not necessarily the case back in 2013, 2014, when the market was really creeping up on lower volume. Any inventory was good inventory back then, not necessarily the case today.
Yeah, and sellers, you got to listen to the market, right? John, you're 100% right. This is extremely important to know. Like, this is a liquidity number. We're doing this as a liquidity thing. This is not price action.
No,
this is not price action. Okay, sellers, prices did not do this, right? This is liquidity. This is the market coming back. There's now a market. There's now a bid, which we did not have back then. So, like, if you're not selling, if you're not getting the traffic and you're not getting the action, you need a reality check. Someone needs to smack you across the head a little bit, right? If you're a broker, don't be scared. Go and tell them what's going on. It's for their better good. Trust me, you want to sell in this kind of market when there's liquidity versus a market when there's no liquidity, like this period back here. And John, let me just point out something extremely important, okay? All of these sales from this period in time, maybe even up to here, right? These have not closed yet and fully come through. So we still have, a big portion of this period of time to come through the sales pipeline, which means, in the future, there's going to be a disparity between what those sales headlines are and what the market might be doing in real time. The market might be in recovery mode, and those sales figures might at a lag finally show all of those COVID trades. So it's going to be really confusing times ahead. So we'll keep doing these reports. Last point is that the deal signed today, that's going to ultimately fuel sales 6-7 months from now. So I think what you got when you look ahead is you got a dip in sales prices coming out, the COVID pipeline, and then you're going to have the recovery pipeline coming in after that. That will probably show a pickup. It's going to be quite interesting to see.
Very interesting. These are very confusing times for sellers. So hold on.
That is why we are here. And that is why we have UrbanDigs. And that is why we have this weekly report. And that is why we have this forum right over there. You got questions, we got answers. Other than that, that is John Walkup. I am Noah Rosenblatt. We're both from UrbanDigs. This has been your weekly Manhattan Market Update. We'll catch you next time.